Hello, and welcome to the Weekly Watch podcast series. I'm John Briggs, Global Head of Desk Strategy. This series helps you cut through the noise of global financial markets with a quick take on the upcoming trends to watch. Hello, everyone. I'm still in Singapore, so I thought I would bring back Peiqian Liu, our Chief China Economist, to talk about all the developments here in the region. But first, before I get to my questions for her on China, I do want to flag that we're seeing continued volatility in rates, but it's also now spilling over into FX markets, in particular, the continued decline in the Japanese yen, which is garnering a lot of attention. As the third largest economy in the world and a huge outward investment base, what happens in Japan has the potential to impact all other assets, especially when things get interesting. And they're definitely getting interesting because the yen has declined about 12% over in the less than 2-month period that we've just seen. In a nutshell, the Bank of Japan is still defending their yield curve controlled monetary policy, where they cap yields through direct bond purchases. But doing so has made them more dovish versus other central banks that are moving towards more hawkish monetary policy, thus the move in the weaker in the currency versus other central banks or the currencies of other central banks, nations which are getting more aggressive and more hawkish in raising rates. And when it comes to the Bank of Japan, they can either fight one, keep their monetary policy, or the other, help defend the yen. So why do I bring this up? Well, because if the pressure continues to build, a weaker yen impacts corporates there. It increases the inflationary pressure in general on the economy. So they have two choices. One is intervention, and one is ending yield curve control. For the former, if they intervene, that's going to inject even more volatility into FX markets, and for the latter, would inject more volatility to rate markets, because if they end yield curve control, you could see a large upward move in JGB yields, which could then unanchor already unanchored global bond yields. So I bring this up because it's just one more thing to keep an eye on. It's one emerging risk. So to keep your eye in Asia, not just for the reasons that Peiqian and I are going to talk about here when it comes to China, but also because the yen and BOJ is a potential risk either way this plays out. So with that, let's turn back to the other major regional player, being China. Peiqian, thank you again for joining me. 3 questions this week, so you're not letting you off easy. First, update us on the lockdown situation, and not just Shanghai, but we're seeing lockdowns in varying degrees across the country.
Yeah, thanks for having me again, John. Just as an update, at the time we speak, half of Shanghai has relaxed its lockdown measures, while factories and ports are prioritized to return to operations. According to the official press release on Tuesday night, the logistics bottlenecks might have been partly lifted as highway traffic returned to around 80% of operating capacity and port returning to normal operations. But however, I think it might still take a few weeks for the Shanghai to fully resume economic activities that mainly focus on services, consumption activities, as case counts are still very high in Shanghai at above 80,000 daily. And the situation outside Shanghai is not looking optimistic because of the firm zero COVID strategy from the central government leaves more cautious sentiment among local governments. So even though the case counts outside Shanghai is relatively low, but local governments are much more risk averse, and they resort to tougher lockdowns with minimum case counts. So according to media tracking and big data, it is reported that around 300 million people in China is under some degree of lockdowns. That's equivalent to the US population, or even 4 times of the UK population, mind you. Yeah.
Yes, it just kind of continues to remind you the scale of everything in China. Yeah. So, all right, given that, how is this impacting your view on supply chains? Is it safe to assume that this just elongates the stagflationary shock that we've seen when it comes to strained or disrupted supply chains?
Well, I think the impact on the global supply chain will mainly stem from the past 3 weeks of full lockdowns, where ports were not operational and factories were forced to shut completely. The closed-loop management that they have adopted might have partially alleviated the pressure, but still, we think that with the limited operating capacity, it's going to cause ripple effects to global supply chain in coming months. In the short term, more visibly, we're going to see longer delivery time for goods going out or going into China. So we might be seeing longer lead time for delivery, reflected in supplier delivery time within PMIs. firstly in China and in the next few months in the UK and Eurozone. And in the long term, I think the prolonged policy uncertainties is adding pressure on supply chain in a way that companies are facing more risk of sudden lockdowns with a short notice time, which means that they have to outsource for different sourcing strategies, which might lead to supply chain diversification in the longer term. So net, I think in a very short term, we're going to see much higher stagflationary pressure.
More another shock that we can't really afford to deal with. Okay, so lastly, what does this mean for your outlook for growth and for potential easing when it comes to policy in China?
Well, in the short-term growth outlook in China is definitely looking very pessimistic. Even though Q1 GDP surprised on the upside on Monday, the March data has already hinted at deteriorating consumption and rapidly worsening employment situation in China. China's unemployment was sort of very sharp uptick to 5.8%, which is the worst since the Wuhan lockdown in 2020. April data, in our view, is going to look worse because that's the major impact of the Shanghai lockdown. Surprisingly, the PBOC has stayed relatively less dovish compared to market expectations. It kept rates unchanged, rolled out only a 25 basis points report cut versus market expectations for more. We think that this might be due to the reason that large part of China is under lockdown or restriction of movement. So with restricted activities, it might not be effective or appropriate time for the PBOC to roll out stronger easing measures. So in our view, the bottleneck right now is not fiscal or monetary easing policy, but rather China's COVID policies. So we have downgraded our annual growth forecast accordingly to 4.7%, which is well below the government target of 5.5. But I think, fiscal and monetary policy will unlikely to be the only levers, and much more focus will be placed on what China is going to do with its COVID strategy. So in terms of a longer-term policy outlook throughout the year, I think three main areas that we should be focused. First and foremost, China's COVID policy roadmaps. We have to see when China is more open to a more systemic approach for COVID outbreaks and a clearer roadmap for reopen, which is essential for China to recover. Secondly, we think China needs much more aggressive fiscal and monetary easing, but the timing might be tricky. It could only be effective when China resumes economic activities. So we think more easing will be likely, including rate and triple R cuts, coming late Q2 when China resumes production and consumption activities. And lastly, I think investors and consumers all need clearer stance on China's property sector policy and tech regulations, which were the factors that weighed on growth prior to this outbreak.
Thanks, Peiqian. Yeah, clarity on their COVID policy, I think, is important, not just for investors, but companies, corporates, shipping executives, everybody, because, like you said, that quick shutdown of things can really, create lots of problems down the chain. As you've previously reported, it could take 3 months, right, for a lot of these issues to kind of filter through to the West Coast or other ports. So, given that, still feel like even if we clear up, we could be feeling the effects of this from some time. So thanks for joining me again. Nice to do it in person as usual. So that's all we have for this week. Next week in the US, we get confidence data and GDP, and the Fed thankfully goes into blackout. We also get sentiment data in Europe, both the consumer and business side, which I'm watching closely because watching to see if there's consumer pullbacks with this tax that inflation is. We've seen consumer confidence over the last month or so start to decline, often to levels not seen since the global financial crisis. So is that passing or is that more sticky? I think could have an important input into the discussion of whether, we're going to have a recession and when. China gets PMI data, and Japan has the now important Bank of Japan meeting. So we'll be watching that thing for sure for reasons we just discussed. So one thing's for sure, we're not running out of things to watch for, and we'll be keeping an eye, hopefully, on all of them. We'll report back next week. Thanks. That's it for this week, and good luck. I hope you have enjoyed this episode of the Weekly Watch. Please subscribe to our channel to get future episodes. We also encourage you to explore more of our content on our website and other social media channels.